Good evening everyone and welcome to the study circle meeting on common points for filing ITRs. This is the season for filing the tax returns now and individual tax returns are happening. So it's time for us to understand what we have to take care in these returns. So today we have Karthik Shastri with us to take us through these points. I request Chairman Pramod to escort the speaker to the dais and also greet him with the floral bouquet. Welcome to you, Karthik. Please take place. Can I request Chairman to give the lecture?
Good evening, members. I know we are getting busier day by day because 30th is shortly due. And all of us are busy filing the IT returns. So as part of our continuous commitment of the programs, we thought why not make our life simple by even talking about the subject. Let's go back to the basics and see what needs to be done. So to deal with today's session, we have CA Karthik. Thank you for being here. So this session is apt for this month. One is that everyone is facing quite a lot of problems and by filing the IT returns, and later on we see quite a lot of computer-aided returns, notices we are getting. So to avoid that and to see where aptly we can disclose in the return of income, so we have designed a session. I request you to take the session, also take Q&As basically to see what is the common issues which is faced by the members also. And I was just discussing quite a lot of new developments have happened also. And if you see the complex ITR, they do even have AIFs and things like that, where you have AIF incomes and AIF expenses. These pass-through incomes need also be suitably aptly disclosed. So with this regard, I would request you to take over the session and give us an enlightenment on what is the common errors and common pitfalls. I would like to call you before I hand over. Thank you. Welcome you.
A quick introduction of the speaker. Karthik is an HR accountant based out in Bangalore, qualified in the year 2021, and his expertise is in the field of direct taxation. He offers comprehensive tax services to various clients in different industries too. Apart from being a CA, he is also a CS professional and a secured EIR 24 rank in CS executive exams. His career commenced at Dhruva Advisors, where he was exposed to corporate tax advisory and litigation and representations before various appellate authorities. He specializes in guiding clients across a wide range of industries. So it's a pleasure to introduce Karthik to you all, and thank you for being here, Karthik, and over to you.
Namaskara. A very warm good evening to each and everyone present here, and also for those who are watching virtually. It's a pretty chill evening, right? Wednesday is supposedly that part of the week where the productivity is too high, because in the case of Monday and Tuesday, we are still in the hangover of the previous weekend, and when it comes to Thursday and Friday, we are in the anticipation of a good weekend ahead. So Wednesday is in the middle of both, where the productivity rate is supposedly at the highest. So, which is why I feel the Bangalore branch also organizes such meetings in the day of Wednesday, so as to have a full-fledged discussion with respect to the professional topics that are there in the community. So, having said this, it is also very important for us to know what are the common points that while filing the ITR we need to look into. There are certain errors that we can avoid, that there are certain precautions that we can take care so that the appropriate processing that CPC happens, and also the chances of getting a notice for a scrutiny is much lower. So with that particular background, let us now start and with the topics for the day, as we call the agenda. So we will first deal into certain basic concepts where we will set up a foundation for the entire webinar ahead, and we will also discuss some of the important changes that have happened in ITR 1, 2, 3, 4 and 5. Predominantly we will be discussing on ITRs that are applicable to individuals, HFs, COPs and partnership firms. We will not deal with ITR 6 and 7 which in itself requires a separate session altogether. And we'll also discuss some of the critical issues. Like for example, I have listed out certain parts of the ITR which require some sort of deliberation. As the sir already mentioned, that there are a lot of developments that have happened in the recent past, and the number of returns that we are getting for F&O transactions, the number of returns that we are getting for RSU allotments are much more than much more than how we used to get maybe 4 years back or 5 years back. So I have listed out some 4 to 5 such issues where it requires some sort of deliberation or some sort of detailed discussion. We'll deal into those 4 to 5 important areas. And the next part of our discussion would be to cover certain general tips which we need to take care of before filing any ITR, and certain precautionary measures that we can take care so that appropriate processing happens at CPC. If we get some time, we'll also discuss a small checklist that is available for sharing it with the client. Say for an individual client, we can ask the client to share the documents in the particular checklist, so that the client is comfortable sharing that particular information in the checklist which you have already shared with them. And at the end, of course, we'll also try to answer as many questions as possible. We'll also deal with some of the topics that, inside the topic itself, if you have any questions. As and when the topic is being discussed, we can deal with those questions as well. So, without any further ado, let us start the discussion with a thank you. This might seem a little odd, right? We are definitely not at the end of the session. We are just getting started. So why there is a thank you that is being written in the third slide itself. So this is like a small token of appreciation for all the professionals in the CA community, because this is the season where we keep aside all our professional commitments, keep aside all our personal goals and all those things, and we ensure that every return of our office gets filed before 31st of July. And recently, 2 days back, I think Income Tax Department also tweeted that close to 2 crore plus ITRs have been filed for the assessment year till date. And needless to say, undoubtedly, professionals in the CA community are one of the main driving forces of filing so many returns and being a part of such a big milestone. So I thought, why not just take a pause for a moment and appreciate all our fellow members in the community in being such a very integral part in guiding the taxpayers, in helping them file appropriate returns, pay appropriate taxes and all that. So I think I would request you all to give a round of applause for all the fellow members, fellow professionals in the community who are actually working day in and day out to ensure that the tax system is working effectively. So as you all know, there is a great statement that comes out from the movie Spider-Man: with great power comes great responsibility. So on one hand, if we have such sort of authority or a power, on the other hand, we also carry some sort of responsibility. Responsibility towards the taxpayers, responsibility towards the revenue, and responsibility towards our own ethical standards. So all these responsibilities will have to be taken care of while we are delivering ITR filing services to clients. Why am I saying this in so much detail is because we all know that the ITR stands for income tax return, right? But unfortunately for a large number of taxpayers, ITR stands for income tax refund. I just came across a small instance I would like to share with you all, which happened in my own office last month. So there is this lady who gets her return filed from me every year. Every year, due to some sort of confusion, she gets tax deducted at a higher rate in office, and by filing the return, we get some sort of a refund. So what happened this year? She has, obviously the new tax regime has become default regime, and the entire salary got adjusted against the TDS that is being made in the salary, and she had some sort of a small interest income or a dividend income, for which there was a tax payment of 4,000 rupees. I guided her in making the payment of 4,000. We filed the return. I sent her the acknowledgement. And then she calls me up and says, "Thank you, Karthik, for filing the return. Now tell me how much refund will I get this year?" So on one hand, or at a very micro level, we all feel that this seems to be a little funny, right? So if you have already made the balance tax payable, you obviously cannot expect for a refund. But at a macro level, this seems to be a little scary. Why I am saying it to be scary is because this tells us the story of the level of financial understanding that the large number of taxpayers have in our country. So which is why I say we as professionals carry a lot of responsibility in educating the clients as to the basics of income tax, what is the tax payable, what is refund, when are you eligible for a refund. So what is the necessity to disclose the components of your income appropriately in the ITR. So we carry some sort of responsibility towards educating the clients. I would like to share one more instance, which one more screenshot in fact, which is getting circulated in WhatsApp groups in the last couple of days. So if you all can see in this screenshot, it is quite obvious that the assessee has opted for new tax regime, and we all know that there is no scope under the new tax regime to avail deductions under Chapter 6A and certain exemption under Section 10 as well. So quite very smartly the assessee has taken all these exemptions under the head any other exemptions under the salary income. So you can see that there is a gross salary of 23 lakhs odd. I also give a disclaimer that I don't know how much authentic is this screenshot, but looking at the screenshot, looks like it is a authentic document which is being shared in the WhatsApp groups. So the gross salary is being shown, against which the assessee knows that the assessee does not have any option to claim HRA benefit under 1013A, does not have benefit of claiming deductions under Chapter 6A. So smartly the assessee has taken all these deductions under any other exemptions given under the salary head. Now we as professionals know this is a deliberate attempt to defraud the revenue, because the assessee is very well aware of the new tax regime and the consequences of opting new tax regime. In spite of knowing such information, the assessee has gone ahead and tried to defraud the revenue. Now what are the consequences? You all know 270A subsection 9, which says if there is a misrepresentation, it leads to underreporting of income as a consequence of misreporting. So this is a clear case of misreporting wherein penalty is as high as 200% of the tax payable. So in this case, the assessee may just know that as on that date, if they file this particular return, they will be eligible for some sort of refund. So I assume if 6 lakh of fake deduction is taken, assuming they are in the 30% slab, they will be eligible for a refund of close to 2 lakh rupees. So imagine if this return gets picked up for scrutiny, the assessing officer will not only ask you to pay back the refund that you have taken inadvertently or mistakenly, or I would say deliberately, because this is a deliberate attempt. So not only have to pay back the refund, also will have to face the consequences of penalty under 270A. So this is why I am stressing so much upon the responsibility among the taxpayer, among the CA community, in order to educate clients and also tell them the consequences of following all these practices. So with this particular background, let us start with the discussion of today's session with the first topic: important changes that have happened in this particular assessment year in the ITRs. And again, I am stressing we are predominantly going to discuss changes that have happened in the ITRs that are applicable to individuals, because this is the season where most of the returns that gets filed in office belong to individual category. So I will be mainly focusing on ITR 1, 2, 3 and 4. Also, I have not picked up all the changes because there will be a lot of changes that keeps happening every year to keep the ITR in line with the amendments that come up every financial year. But I have picked up only major developments in the ITR and also major changes that we all should take care of before filing any income tax return. So these are the notifications by which the ITRs have been notified for the assessment year. This is just for information. So the first change which we are going to discuss is that there is a new insertion in Part A General which asks the taxpayer to choose what is the due date for filing the return. So this option was not there. The assessee had to just pick which section under which the return is being filed, whether it is 139.1, 139.4 or 139.5. But additionally, from this year, we have to also choose what is the due date for furnishing the return for that particular assessee. So 31st July, 31st October, 30th November, we have to choose this, and this change has happened across all the ITMs. And there is a recent development in the RBI guidelines that for any transaction exceeding 50 crore rupees, there has to be something called legal entity identification number. So needless to say that even if the income tax department has to process the refund of more than 50 crores, the income tax department also should have access to the ADI of the client, which is why if your refund amount is more than 50 crore rupees, it is mandatory that you report your LEI in the ITR so that the income tax department can process your refund appropriately.
Legal entity, I am not aware. Legal entity means a SIN number like that?
No, it's not a SIN number.
I am not aware, that's the reason.
No, it is not a SIN number. It, as per the new RBI guidelines, if you are making any transaction where the transaction value is exceeding 50 crore rupees, you will have to obtain something called LEI number.
From
Yes, from the RBI authorities. So once you get allotted the LEI number, only when the bank will process any transaction which is exceeding 50 crore rupees. Otherwise, the bank will not process that particular transaction.
This LEI, where we have to get it?
I'm not very sure on the process of obtaining LEI.
There is a website for that. Legal entity identifies as people who there are multiple people who are providing the services
Okay.
with an yearly charge. So who is having loans, not just 50 crores, if they have a loan about 10 crores itself from this financial year, LEI is mandatory for the client to be obtained.
Okay.
So you have to pay a certain fees every year, or 3 years, 5 years like that. You have to pay that amount and they have to obtain the LEI.
So this is the recent thing.
Yes, this is
Legal
from
entity.
this.
No, LEI number.
LEI, I suppose it is there from the
It's
past.
also
years.
past for a few years.
Yeah, it is there from
Limits
past
are
years.
reduced now. Earlier it was 25 crores, 30 crores ago. Now from this year it is 10 crores.
Okay. So the next thing which we are discussing is under the tax audit segment. So all these years we had to just choose whether we are liable for tax audit under section 44AB or not. From this year we also have to choose additionally as to what is the reason why you are opting for tax audit. So whether the sales or turnover or gross receipt is exceeding the threshold limits prescribed, or whether it is because of violating the presumptive taxation provisions. So we have to choose the appropriate sale over there. And accordingly, there is also another change in the audit report segment itself. This is a welcome move actually, because what used to happen, sometimes by mistake, what used to happen is the tax audit report was missed out to be filed, and the ITR was getting filed. Because in the ITR, we did not have the option to enter the acknowledgement number of the form 3CA or 3CB along with the UDIN. So many a times by mistake or unintentionally what was happening is that you miss out on filing form 3CD, and in that hurry you just file the ITR. And this happens especially at the fag end of the season where there is a lot of returns to be filed, and here and there maybe 1 or 2 3CD just gets missed out for filing. So that actually might have some serious consequences, including penalty and 271B and all those things. So this is a very good welcome move, that without entering the acknowledgement number of form 3CA or 3CB, you will not be able to file the ITR. This is mandatory. When once you choose your liable for tax audit, you should also enter acknowledgement number of the 3CD of the audit report, and also the UDIN that is generated by the auditor.
You mean to say only UDN you are talking about, even the acknowledgement which is given by the
Yes,
department?
both will have to enter. Both will have to be entered in the ITR. This is one more change that has happened for assessment in 24-25. We all know that the limits under 44AD and 44ADA have been enhanced, provided that your receipts in cash is less than 5% of your total receipts. So in case you are opting for 44AD, before the threshold limit used to be 2 crores, but now your threshold limit will be switched to 3 crores, provided receipts in cash is less than 5%. So accordingly, in presumptive taxation for 44ADA also, 50 lakh limit will be switched to 75 lakhs in case receipts in cash is less than 5% of the total gross receipts. So just to have like a small check in the ITR itself, the ITR forms have been changed to include how much is the receipt that you have got through banking channels and how much is the receipt that you have got in cash. So what happens in this particular E1 tab? In row A, we enter how much is the turnover that we have received through banking channels. In row B, you have to enter what is the total turnover you have received in cash. So the total of A and B will become your turnover automatically. That will be keyed in the E1 column, which describes the total turnover for the assessment year. So here what happens? The system will automatically check whether the amount entered in row B is less than 5% of A plus B. So it's a very simple math calculation which the CPC will do, and if it exceeds 5%, the CPC will throw an error saying, and provided you are, you have opted for that enhanced limit. So if it is below 2 crores or below 50 lakhs, that particular check will not have so much of relevance. But if in case you are having a turnover of more than 2 crores and less than 3 crores, or gross receipts in case of profession of more than 50 lakhs and less than 75 lakhs, this particular simple math calculation will be done at CPC level, or maybe even at validation level the rules would have been set so as to ensure eligibility under 44AD and ADA have been complied with. So same change has happened in both the sections under 44AD as well as 44ADA. And we all know one of the most viral topics in the last 1.5 years have been payments made to MSME vendors. So the law was there from a very long time. This also goes and tells us the importance of income tax law. Income tax law also not just helps in collection of taxes, but also pushes the taxpayers to comply with other laws. For example, we have something called employees' contribution towards PF. That law is always there, but how many clients in our office pay that particular PF contribution within the due date because there is a deadline given in PF Act, versus how many clients remit that particular contribution within due date because there is a disallowance in Income Tax Act. The latter will be more. Because there is a disallowance in the Income Tax Act, the clients will be more serious about complying with other laws. So this MSME regulation that is put up under 43B is a classic example of that. This particular limit of 15 days when there is no agreement, 45 days where there is an agreement, is there in the MSME Act from long time. I suppose it is there since its inception. But it is being discussed at all its length and breadth only after introduction of 43B clause H. So since this particular amendment has come in the last year, under disallowances or allowances to be made only upon payment basis under 43B, there is a new insertion which says any sum payable to MSME which is paid beyond the limits prescribed in section 15 of the MSME Act. So whatever amount that you enter in this particular row will be taken as a disallowance in the ITR. It's a simple disclosure. Also, we all know that if you are availing any deduction under capital gains, you have an option to deposit the amount of deduction you want to avail, or deposit the amount of investment that you have to make in an account called capital gain account scheme. Suppose you have sold a property in November 2023. You have time till November 2025 to purchase another property in order to claim a deduction under 50, maybe it is under 54 or it could be under 54F also. But what happens is before filing the income tax return for that assessment year, which is going to happen in July, if you are not able to purchase or construct the property, you have to deposit that particular amount in an account called capital gain account scheme. This is a very simple process in the bank. You just have to open that account. So what used to happen is the ITR was not designed in such a way to ask the account details of that CGAS. So what used to happen, obviously it is going to tackle those who are taking fake deduction, saying I have deposited in CGAS, but they wouldn't have actually deposited in any capital gain scheme. So they would have just put the date of deposit as July 30th, and the law is being complied with, the deduction is already available in the ITR. But now they have brought in a very good amendment in the ITR so as to include the date of deposit, not just date of deposit. They are also asking for the account number and the IFSC code of the capital gain account that you open in the bank. So this is a very welcome move, and this particular change in the ITR was long due, and it is being implemented in this year. And there is a new section for taxing winnings from online games. A new section, that is section 115 BBJ, is introduced with effect from assessment in 24-25, wherein the net withdrawal that you have from online winnings will be taxed under this section at the rate of 30%. So since this is a new section, that is a special rate, this comes under incomes that are chargeable under special rates. So under that particular schedule, a new line item is added to tax winnings from online games. And there is another change that has happened. Section 80 GGC is any reduction, any investment, or I would say contribution. Any contribution that you make to any political party. For companies it is 80 GGB. For other than companies, that is allowed under 80 GGC. So if you make any donation to any political party, you just have to enter the amount of deduction all these years, but from this year you need to also give details. There is a new schedule that has come up. So as per the schedule, you have to give the details of the exact investment made in which mode, and investment made to which bank account of the particular party. All those details you have to detailedly give. More, I have never come across any client in my limited experience who have availed this particular deduction. But in case in your office somebody has contributed, because this is a season of election, so there are chances that somebody would have given some contribution. So if at all there is some sort of contribution, we'll have to make this particular disclosure in the ITR. There is one amendment in section 192 which by way of an insertion of subsection 1C, which defers the tax deduction on ESOP allotted to a employee of an eligible startup. This came in the year 2021, wherein I'll give you a small example. Say a startup has allotted a number of units to its employees in order to retain those employees for future purposes. So what happens, let's say your salary is 20 lakh rupees and you have been allotted shares worth 20 lakh rupees. As per 17(2) of the Act, this becomes your perquisite. But on that particular perquisite, say for example 20 lakh is your salary under 17(1), 20 lakh is your perquisite under 17(2). You have actually not got anything in your bank account, but against which there is a tax deduction happening. So this seems to be a little unfair. So to give some sort of a relaxation for eligible employees of an eligible startup, the government came up with a tax deferral. So what used to happen, even though the chargeability of tax is there in the current year, government gave some sort of a relaxation of 5 years. So from the end of the assessment year, you have a time limit of 48 months to defer this particular tax deduction. So the time limit is maximum 48 months from the end of the assessment year, or the exercise of the option, or the cessation of the employee with that particular company, whichever is earlier. So there was a schedule for disclosing this particular information, but the new change that has happened in this year's return is that we have to also mention PAN of the employer and DPIID registration of the employer. So this could be some sort of a cross-check between returns that are filed of the employees of the eligible startup vis-a-vis the return that is filed by the eligible startup itself. Because in ITR 6 also we have an option to disclose DPIID number if you are an eligible startup. So maybe to have some sort of a cross connection, this is a new amendment that is being made in the ITR.
Excuse me, it's only related to, new companies, startup companies?
Yes.
Not others?
Not others. Only for eligible startup there is this relaxation. For other companies, normal tax deduction happens at the time of allotting the ESOPs. A new section 80CCH was introduced for Agniveer corpus, wherein if you are enrolling for that particular scheme, a portion of your remuneration gets deducted from your salary, and that will be deposited as a corpus towards Agniveer corpus, Agnipath corpus or Agniveer corpus fund it is called. So that particular portion of salary that gets deducted from your salary and goes as a contribution to Agniveer scheme, Agniveer corpus fund, that is allowed as a deduction under 80CCH. So a very important point to note here is 80CCH deduction is available both under old tax regime as well as new tax regime. So this particular deduction is being inserted under the schedule chapter 6A, so as to take this particular deduction. ATU and ATDD are both identical sections. So ATDD and ATU deals with a deduction with respect to a sum of 75,000 and 1,25,000 if you have a disability vis-a-vis severe disability. So if you are taking care of a person who is dependent on you, you can avail deduction under ATDD. If you yourself are suffering from that particular disability, you can take a deduction under ATU. So there was a form which is called Form 10IA, but many a times what used to happen is, because we don't have an option to upload Form 10IA along with the return, there could be some chances that the assessees can take this deduction even without obtaining Form 10IA. So what has happened from this year, Form 10IA filing has become mandatory on the portal itself. So we have to take certificate from the certified medical authority. We have to fill in those details that are there in Form 10IA. We have to file that Form 10IA. We have to also enter the acknowledgement and date of filing of that Form 10IA in order to claim deduction under ATU and ATDD. So in addition to ATU, in ATDD what happens, you also have to define for whom you are taking this deduction and what is the relation with that person. You have to select whether it is son, daughter, wife, parent. So we have to choose that particular relative option and then we have to take this deduction. So for filing of Form 10IA has become mandatory online and we have to take certificate from the certified medical authority also before filing the form. Reporting of bank account state, there is a new column added at the end. We will also now have to report what is the type of account, whether it is savings bank, whether it is current account, whether it is an NRO account. So these kind of what is the nature of account, we will have to enter in that last column which is newly inserted, type of account. ATIAC, there is a new schedule itself wherein the eligible startup claiming deduction under ATIAC will have to give these details. What is the date of incorporation, what is the nature of business, what is the certificate number that is obtained for claiming ATIAC deduction, and what is the first year in which you have claimed this deduction, and what is the amount of deduction that you have availed. This is a new schedule that is being inserted. So these are the details that you have to give. There are very handful of startups which are approved under ATIAC, even though the number of eligible startups are way too high. The number of startups that are being given approval for taking deduction under ATIAC is very, very small. So for those companies that have got this particular approval, will have to fill this schedule before filing the ITR. Details of MSME registration. This is a new insertion in ITR 5 and 6. So if you are registered under the MSMED Act, you will also have to give yes or no against the question whether you are registered as MSME or not. So if you select as yes, you will also have to give the registration number that you get in the MSME certificate. So this also could be a criteria to decide whether you are a micro, you are a small, or you are a medium enterprises. So this maybe the government is planning for an information exchange between income tax portal and the MSMED portal to automatically update the details as per whatever you enter in the income tax portal. And also there is a new development that has happened. All these years we had to verify the returns that are subject to tax audit using the digital signature. But from this year, we can also avail the option of using electronic verification code for verifying the returns that are subject to tax audit. So that is some, in a lot of places, this burden of filing using digital signature is, day by day is getting reduced. So maybe this is one of the ways in which we are slowly getting rid of DACs for income tax portal purposes.
It applicable both for tax audit as well as ITR?
Yes, this is for ITR, not for tax audit.
Not for
The auditor will have to still upload using the digital signature, but the assessee who is subject to tax audit can verify using an EBC. So we come to the end of this first part of the discussion. Before we proceed to critical issues, we'll just take a moment, and if you have any questions, we can address them.
Under new scheme, under section 24, is the 30% house repairs allowed? That is so only standard deduction and this
Under the new scheme, sir, under the head house property, two things are allowed. One is 24 clause A, which is a standard deduction of 30% of annual value. Under clause B, interest that is paid to borrowed capital is allowed only with respect of let out property. So if it is a self-occupied property, deduction under 24B is not available under the new scheme.
Without property can show a loss and then that can be set off.
Yes, yes. There is no restriction on set off of losses.
Self-occupied loss.
Self-occupied, there is no option for me to claim interest itself. So there won't be a question for me to claim losses from that source. But if at all there is a loss arising out of a let-out property, I will have an option of settling it on the case.
but the limit is 2 lakh.
Yes, as per 71 subsection 3A, the maximum inter-head set-off from house property against any other income is set to 2 lakh rupees. That limit is changed in 2018, so from last 5 years it won't.
No, even the deduction of interest is limited to 2 lakhs only.
Only with respect to self-occupied property. With respect to let-out property, there is no limit of taking a deduction under 24B. The interest could be 4 lakhs, the interest could be 5 lakhs. But the set-off amount against other heads of income is restricted to 2 lakh rupees. Balance amount beyond 2 lakh rupees will be carried forward to the next year.
This ATU, ATDD are not visible in the new receipt.
No, not in the only in the old regime it is only. In the new regime, there are only 3 sections. One is 80CCD subsection 2, which is employer's contribution to NPS, 80CCH, which we discussed, the contribution to Agniveer Corpus Fund, and 80JJAA is still available under new tax regime. The deduction that is given to a assessee who is subject to tax audit for an additional employee cost that is being held. Of course, there are a lot of conditions in that section, but that deduction under that section is not restricted under new tax regime. So these are the only 3 deductions that are available under Chapter 68 for new tax regime.
This capital gains scheme, IOP deposit, suppose the property is sold in the month of February and we got 6 months time to deposit the amount from the date of the sale.
No, that 6 months time limit is there to avail deduction under 54EC, not under deposit for CGAS. And if the time limit for depositing amount into CGAS is before filing the ITR. Yes.
So I can sell the property.
Yes.
But before filing the return?
Yes, before filing the return, if you are not able to invest in new property till that time, you will have to deposit that investment amount in CGAS and report all these disclosures. So we'll proceed with the next one. So I have identified certain critical issues, or I would not say issues, but these are the points where predominantly professional discussions happen and a lot of doubts that come up on WhatsApp groups or any other forums where people are not able to identify what should be the right disclosure for a particular type of income. So I have identified 2-3 such issues which we will deal in the coming slides. The first main confusion, which is actually not a confusion, but people have created a new confusion. All these years, what used to happen, old regime was the default regime and new tax regime was an option given to the assessee. So what used to happen in the ITR, if I have to choose new tax regime, I had to select yes under something called you wish to opt taxation under 115 BAC. Now from this year we all know that new tax regime has become the default regime, and if you have to opt out of new tax regime, you will have to select yes. But what happens is we are so accustomed to selecting yes here for opting for new tax regime that even professionals are getting confused. So if we read the line properly, it says, do you wish to exercise option under subsection 6 of 115 BAC for opting out of new tax regime? So if you want to opt old regime, you need to select yes in this particular cell. If you want to stay in new tax regime, you don't have to do anything. This is automatically no in the portal or any software that you are using. Automatically the portal or the software will take you under new tax regime. So only if you are choosing old tax regime, we have to select yes in this cell of the ITR. This comes under Part A general. So here you have to select yes if you want to opt for old tax regime, stay in no if you want to stay in the new tax regime. There are certain disclosures that come up as a discussion under the head salary. First part is the breakup of salary. So what happens in ITR 1, we don't have the option to give breakup of salary. Like there is basic pay, there is HRA, there is special allowance. So we can club everything and we can disclose the main components of salary, that are salary under 17.1, perquisites under 17.2, profit in lieu of salary under 17.3, out of which we take deductions and exemptions that are available for the assessee. But what happens in ITR 2 and 3, and that is applicable for both 1 and 4. So in ITR 1 and 4, you just have to enter the salary as a total salary under 17.1, 17.2, 17.3. But what happens in ITR 2 is that you have to give breakup of each of the component. Say if you are having salary under 17.1, you cannot just say entire salary is 17.1 salary. You have to give breakup of what is your basic salary, what is your HRA, what is your special allowance, what is the bonus, what is the meal coupon. So all these things you have to give like a separate breakup. There is an option to give breakup, and if there are if you have a component of salary which is not listed in the ITR, you also have an option to report it under the column others. So you have this particular option in ITR 2 and 3. Why this breakup is so important is because, say you are using some software or you are using some other third party where if you don't specifically give breakup of salary, everything will go and sit in basic salary. The entire salary will go and sit in basic salary, and in the column of exemption, if you are opting for exemption under 1013A for HRA, the CPC will think you are not earning HRA but claiming HRA. What happens there? There is a difference. The CPC proposes an adjustment saying HRA is not a part of the component of your salary, but you are claiming as exemption. which is not allowed technically. So it is very important for us to see the ITR preview once before we file, and appropriate components of salary as basic HRA, everything is predominantly filled as a proper disclosure before we file the return. So that is one thing which we need to take care of specifically.
To my knowledge, if I did not do a breakup of HRA, system will not allow. I think
Yes. I think this year that system has become a little smart, but last year we have seen a lot of returns where CPC has processed like that, saying it is not forming part of your salary, but you are taking a deduction. So that is why I have mentioned the second part also. Exemption should first form part of your salary. So there could be certain components of salary where it is a direct exemption. You don't have to think too much about that. Say for example, there is a gratuity payment upon retirement up to 20 lakhs under section 10 clause 10. So what thought will go to our mind is gratuity is anyway not taxable, because even under the gratuity law, the maximum limit that you can pay to a person is 20 lakhs. So up to 20 lakhs you will receive gratuity, and you will automatically think anyway it is exempt, why should I even report? But there are chances that the employer, while filing 24Q, would have included this gratuity amount as a part of the salary, and subsequently would have given an exemption. So if you don't keep this as a part of your salary first, but say for example your total payouts as a retirement is 40 lakhs, out of which there is a gratuity component of 20 lakhs. What you thought? 20 lakhs is anyways exempt. I will report balance 20 lakhs which I have received. But in 26As or in Form 16B, what has happened? There is a salary of 40 lakhs and there is an exemption of 20 lakhs. So net taxable salary is matching with what is reported in Form 16. But what CPC will do? The gross salary which is there in 26As or the Form 16 is 40 lakhs. But the salary which you have reported is 20 lakhs. What happens? Adjustment. So CPC will send out a communication for proposed adjustment under 143(1)(a). So to avoid such things, you should always think that exemption should first form part of your salary, and then you can take deduction, and then you can take exemption. So we should never forget this particular aspect. And one more thing, there is a requirement.
But normally Form 16, wherever we are getting, there is no breakup of HRA,
Correct.
basic. I tell you, if somebody is not claiming any provisions under section 10 like HRA, children education, but on the circumstances, what is the best way we have to put? Whether shall we put everything in others? If we are keeping in others, will not create a problem from the CPC, or shall we keep everything in the basics?
I think that would be a better disclosure.
Because nobody, others means immediately the department will be little uncomfortable.
Correct. Because I don't think there will be any salary without basic salary. Unless it is a pension income. Okay. So apart from pension, any salary will definitely have basic salary, upon which other components will start building up. So I think instead of giving it under others, if the assessee is not claiming any exemptions and you don't have the details of breakup, you can put it under basic salary.
Usually Form 16B gives the breakup of the salary.
Yes, but in most cases they don't give money.
No, normally 12BA or BDA.
That will cover all your perquisites and all those things.
But in many of the cases you will not get it. That is the
we have to specifically ask for the annexure to Form 16, or you should also ask, we have an option in the HR portal of the employer to download a tax projection sheet for the year. So what happens is, because client will know that they have something called tax projection sheet. If we ask them to give an annexure to Form 16, they will not understand. So either it will be called a tax projection sheet, or in few companies it is also called statutory forms. So if we ask the client to give either of that, the client will be very comfortable to download. And in your case, there is no exemption at all, and we don't have the breakup. It is better to show everything on the basic salary. Yes.
Or in worst case, we have to ask 1 month pay slip.
Yeah, March month pay slip will usually have YTD information, but I've been seeing a lot of March month pay slips do not contain such information.
It may not be universal for all the months.
Correct. So we cannot really rely on that. So we have to rely on either the statutory form or the tax projection sheet. Of late I've been seeing that Form 16s, generation of Form 16s have become very lazy these days. The HR department of the company are not putting that extra effort to give all this information so as to give an appropriate disclosure in the return. before I was seeing that every Form 16 used to contain, after the Form 16 they used to give breakup of salary, how much is the basic, how much is the HRA. But these days I have been seeing that the HR department has become little, over dependent on systems and appropriate forms are not being generated. So
even for that matter, ATC also they will give a
correct,
club
correct,
figure.
correct,
What is
correct.
PF, what is LIC, what is
Correct.
nothing they are giving.
Under 17.1, when they show the gross salary, in Form 16 they will show gross salary under 17.1.
Correct.
But when you put the breakup, whether you put in basic or you put in others, there will be no difference, no, because in any case gross salary will be gross salary and 26AS will show gross salary.
Correct.
Then you keep claiming 10 under, even if you claim education allowance or hostel allowance, even if you have put in others, it is still coming in 17.1 as gross salary. So both will match. The ITR of gross salary will match and the 26AS of gross salary will match.
As far as matching with the total gross salary is concerned, your point is yes, sir. But there are certain exemptions that are directly linked to a particular component. Say for example, HRA exemption. So HRA exemption cannot come where there is no HRA, because one of the criteria for giving HRA exemption is actual HRA receipt. So if you don't put it under the component of HRA, the system will assume HRA is 0. So the least of that will be 0.
No, now the system itself is throwing an error. It is not allowing us to go ahead at all without putting the breakup.
No, you can put everything in others, but what he is saying is correct.
That's
That if there is a HRA, you have not put in HRA, then
so
deduction
any
will not.
exemption which is directly linked, say for example gratuity. So if I am claiming 10-10 exemption for gratuity, there has to be a gratuity component as a part of my salary. Otherwise, there will be no one-to-one matching between.
And also ATCCD deduction, that is also 12% of basic. So
Yes,
if you don't
yes.
put basic,
Correct.
it does
That's
not
a very
accept
good point. That's a
ATCCD.
very good point. So if you don't put basic salary appropriately, there are chances that CPC will calculate 10% or 12% of the basic salary to be a very inappropriate number, and denial of deduction under 8062 also is possible. So that is also, so because of that also we have to give appropriate disclosures in the salary head. So the crux of the discussion is that we need to try as far as possible to take the breakup of salary. If we do not have a breakup, we will have to end up entering entire thing in the basic salary, and provided there is no exemption that is claimed. So there is one more. So we discuss the third point. It says entire under the TDS salary schedule, we have the option to report what is the gross salary that I have offered to tax in this return. So in that gross salary part, we have to make sure that we enter the gross salary and not the net taxable salary. So that gross salary that we enter in schedule TDS will first be matched with the scheduled salary, whether what you have entered is correctly reported in the scheduled salary. On the other hand, it will also be processed with 26AS. So under 26AS, the gross receipts will be reported against which a TDS deduction would have happened. So with that number plus what is reported in scheduled salary, both will be mapped with the gross salary amount that we enter in the scheduled TDS. So in scheduled TDS, please make sure we enter gross salary and not net taxable salary. And there is one more point which I have to discuss. Please obtain F&F reports whenever there is a change of job. So assuming an employer has changed jobs, so it is very important for us to obtain F&F reports, which is nothing but full and final settlement report that the employer will give, to explore certain exemptions. They say, for example, leave encashment. There could be some component of leave encashment where the employer wouldn't have given exemption. So if the assessee is eligible for leave encashment exemption, we will get to know only from the F&F report that the assessee has actually obtained leave encashment. So it is very important for us to obtain F&F report to explore such small tax planning options. Look out for allotment of ESOPs and RSUs. This is very important. So after the COVID, the number of employees that are being allotted with ESPPs, ESOPs and RSUs have been at all-time high. Because a lot of multinational corporations, instead of paying out actual salary, they decided instead of giving them salary into their bank account, why not we allot a particular a small share in our company, so that maybe after 5 years or maybe after 10 years, the SSC will have the benefit of appreciation in the share price of our company, and they can exit at that particular higher rate. So under 17.2, this allotment of ESOP and RSU at a concessional rate will be chargeable under the head perquisites under 17.2 clause 6. So always look out for any allotment of ESOPs and RSUs. Why I am stressing on this point is because if at all there is an allotment of ESOPs and RSUs pertaining to a foreign company which is listed in a country other than India, we also need to disclose the holdings as on 31st of December in Schedule FA. We will discuss that in detail later. So as far as salary is concerned, you should always look out whether there is a ESOP allotment or an RSU allotment that has happened, and if there is an allotment that has happened outside India, you should also obtain reports, you should also obtain holding statements, and if there is any dividend income that is arising on that allotment, we will have to report incomes and holdings accordingly. And also see whether there is any arrears that is received. So say for example, if the assessee was in a 10% slab 5 years back, so that point in time the assessee was liable to be paid another 10 lakh rupees or 15 lakh rupees, let's say, and as on today that arrears is being received in the assessee's bank account, and as per section 15 the salary is taxed on due or receipt whichever is earlier. So if there is any dispute happening or if there is any bipartite settlement that is pending, that particular part of the salary is not yet due. So that becomes due today and it is taxable to me today, but as of today I am in a higher slab rate. So what happens, this was supposed to be received when I had a 10% slab rate, but now it is being received and I am paying taxes at 30% now. So in that case what happens, there is a small amount of relief that is given under section 89, and that relief is given only against arrears of salary. So we should also look out if there is any arrears component in the salary, and we can explore relief provisions accordingly. For availing relief under 89, there is another form which is Form 10E to be filed on the portal, upon which relief can be claimed by the assessee. So these are the main points that I had to discuss under the head salary. So coming to PGBP, this is one of the main points of discussion for today. The first point which I felt is important for discussing is books maintained versus books not maintained. Who are required to maintain books of account? Who are not required to maintain books of account? So as per section 44AA of the Act, there are two limbs. One is subsection 1, the other is subsection 2. Under subsection 1, it prescribes a list of professionals who are mandatorily required to maintain books of account. Chartered accountancy profession is also one of such professions. Say for example, engineer, architects, lawyers, doctors, all those professions that are listed in subsection 1 of 44AA are required to mandatorily maintain books of account irrespective of their turnover limits. But under subsection 2, apart from other than those who are listed in subsection 1, if you are carrying on a business or any profession other than listed in subsection 1, you have to mandatorily maintain books of account. Under this, there are two categories. One is if you are an individual, if you are other than individual. So for individuals, we have a limit of turnover up to 25 lakhs and a profit of 2.5 lakhs. And if you are other than individuals, the turnover limit is 10 lakhs and the profit limit is 1.2 lakhs. So keeping our discussion restricted to individuals, say for example, if my turnover is more than 25 lakhs, I have to definitely maintain books of account. But what is the exception for that? Exception is when you opt for presumptive taxation under 4480 and 4480. So although in the new section, long ago there used to be 44AF and all those things where presumptive taxation was structured, wherein inside the section itself there was a subsection which said if you are opting for taxation under this particular section, you need not maintain books of account under section 44AA. But unintentionally, insertion of that subsection has been missed out in the sections that are there as on today. Under 44AD and 44ADA, if you go and read the section, inside the section there is no mention that you don't have to maintain books of account. But even the FAQ of the department, even the material that is released by the department also agrees that the intent of the law is to maintain that position. And if you are opting for presumptive taxation, you need not maintain books of account. So, what are the things that we need to disclose in terms of books not maintained cases? So if you go to ITR 3, there is an option for me to either report the entire books where I give details of balance sheet, I give details of P&L, wherein the net profit will be taken to the computation. On the other hand, there is also an option to report particulars where books are not maintained. Under books not maintained, there are 2 points. One is you are not breaching the thresholds where your turnover is less than 25 lakhs, profit is less than 2.5 lakhs, where you have actually not maintained books of account. The other point is when you opt for presumptive taxation. In both these cases, there are certain financial particulars that we need to mandatorily disclose. So even though I don't maintain my books of account, there are 4 components that I have to still report. Those 4 components are sundry creditors, sundry debtors, inventory and cash balance. So these are the 4 financial details that I have to enter in ITR even though I don't maintain books of account. So these disclosures should not be missed out, because if you don't enter that, ITR will not be validated. So for validation we have to keep searching, because that error is very difficult to find. It says you have not entered complete details under schedule so and so, but we will not get to know that what is the exact details that we have to fill in. So if you have a case where books are not maintained, please make sure these 4 entries are always entered in the financial particular schedule, so that validation happens smoothly. And also there are certain items in P&L account. This is of course for those maintaining books. Under the P&L we have 4 items wherein we have to give breakup of how much is paid to non-residents and how much is paid outside India. So I'll just take one example. If there is a commission expense in your P&L, you should always give a breakup of these 3 things, whether it is paid outside India, or whether it is paid to a non-resident in India, or whether it is paid to other than the above 2 categories. So if you don't enter anything, the ITR will automatically take it as others. Even if you are using any software in your office, if you just enter the commission amount or royalty amount or fees for technical consultancy or professional fees under that head, and if you don't give any breakup in the below tab, it will automatically take it as others. Why is this very important? To process requirement of tax deduction under 195, wherein if the amount is being paid to a non-resident or it is paid outside India, there are certain other implications of TDS under 195 and all those things. So to maybe analyze those applicabilities, these particular heads have been given an option to disclose where it is paid outside India or to a non-resident in India, or it is paid to others. So this particular disclosure is very important. If you don't enter anything, it will automatically take it as others. Also, rates and taxes, if you can, you should always give bifurcation. There is always an option to report others under rates and taxes also, but as far as possible, just try to give bifurcation as to how much is paid as IGST, or is paid as CGST, how much is taken as STT, securities transaction tax, or any other tax like professional tax and all those things. You can, as far as possible, just try to give breakup of that rates and taxes in the rates and taxes schedule. There is one more requirement. If there is a bad debt as a component of your P&L, if a bad debt from a particular customer is more than 1 lakh rupees, there is a requirement for us to report either PAN or Aadhaar of that person, or if you don't have both PAN and Aadhaar, there is a mandatory requirement to report complete name and address of that particular party. So this is very important. Why? Because I also had a case in my office wherein the assessee has reported bad debts but has failed to report PAN and Aadhaar of that customer. So what CPC has done? CPC has disallowed the entire bad debts expense. So this becomes very difficult because we tried for a lot of rectifications on the portal, nothing worked, and ultimately we had to get the manual order from the assessing officer. So this is very important for you to mention PAN, Aadhaar of the customer. If you don't have PAN or Aadhaar, you should always mention what is the name and the complete address, provided the bad debt from that customer is more than 1 lakh rupees. If it is less than 1 lakh rupees, you can club it as others. But if it is more than 1 lakh rupees, you have to give breakup of each of the customers.
This is as per rule requirement. Is it as per rule or in ITR?
It is there as per ITR. There is no rule for this. The rule specifies you have to file ITR and disclose the information contained there. So whenever CBDT notifies any ITR, it becomes mandatory for us to follow the rules that are prescribed in the ITR. So that need not specifically come from any section or need not specifically come from a rule, because ITR in itself specifies what are the disclosures I have to make in filing the ITR. Coming to disclosure in capital gains, there are 2 things in capital gain, as you are aware. One is short-term gain, the other is long-term gain. So as far as long-term gain is concerned, every capital gain needs to be reported along with the date of purchase as well as date of sale. If you go to the appropriate schedule of long-term capital gain, it will always ask you to report what is the date of purchase and what is the date of sale of that transfer of capital asset. But when it comes to short-term capital gain, no matter what is the nature of capital asset, you can always club all the transactions and report the total sale consideration and report the total purchase cost. Say for example, I have hundreds of transfers that have happened in the stock market, out of which 50 are short term, 50 are long term. So what do? For short term, if I don't have any software, that I'm fine, because most of the software will have auto classification tables wherein you just enter all the transaction details and the software will automatically take what is short term, what is long term. But if you're filing it through utility, you have to identify what is short term, identify what is long term. Under short term, you can directly club all the sale consideration amounts and put it as total sale consideration, and club all the purchase cost and put it as cost of acquisition. So that much minimal disclosure is sufficient. But when it comes to long-term capital asset, you also have to disclose something called date of purchase and date of sale. And if it is a long-term capital gain in the nature of 112A, there is a separate schedule for 112A. So you have to fill in the schedule called Schedule 112A, wherein you also have to give additional details of whether you have purchased it before 1st Feb 2018 or after 1st Feb 2018, and if it is purchased before 1st Feb 2018, you should also disclose the ISIN of the security. And needless to mention, you have to give script-wise details. You cannot club all the sale consideration, you cannot club all the purchase cost. You need to give script-wise sale details under Schedule 112A. But if it is short term, just add up all the sale consideration, just add up all the costs and enter the total amount and arrive at the capital gain.
No, since last year, even in the 112A schedule, if it is post 35 January 2018, it will not allow you to enter script. It will block all those things. You have to enter only the gross amount.
Okay.
Since last year, for 3 years it was allowed, but since last year it is you have to enter a block.
Okay.
If it is, there is no grandfather clause, that is after.
But if it is before
Yes, you have to enter script wise.
Even in short term, it will be the date of purchase.
No, we will not give date of purchase. No matter what is the nature of capital gain, we can directly give total amounts. The next part is quarter in which income is accrued. It is very important because we need to calculate something called interest under 234C, for which the accrual of income that happens in each of the quarter, those details will have to be given. So the total of amounts that you enter in all the quarters put together should match with the total capital gain that you report on the above schedule. For NRIs, you should also see whether the broker house has done TDS, because for NRIs under section 195, on the net capital gain, the broker house is also liable to deduct taxes under 195. So that is a clear indication that the NRI has sold shares during the year, and you can ask for the capital gains report for that year so that you can make appropriate disclosures. For intraday transactions, how do we report? For intraday transaction, it becomes a speculative income. So this automatically goes to PGBP and not capital gain. So if there is an intraday transaction of equity that is happening, so you need to disclose these three things. What is turnover, what is profit and loss, and you should also disclose what are the expenses that you want to claim. Here again, it becomes like a very stringent mechanism wherein you have to also disclose what is the turnover, because in F&O transactions, I will discuss in a while, you don't have the obligation to disclose turnover in the ITR. But what happens to speculative transaction, unless you report the turnover, the validation will not happen. So you also have the additional liability to disclose what is the turnover, what is the gross loss, what are the expenses that you are claiming against this particular profit or loss, and the net profit will be taken as profit or loss from speculative transactions.
One question, intraday, generally people do intraday, and you are saying you report turnover.
Yes.
Will it not go to tax audit then at that?
No, there is a specific guidance note on that. So it says turnover is not the sale transaction, adding up all the sale transactions, but turnover is nothing but the absolute addition of the profit and losses arising in a particular year. So let's say you have one favorable transaction of 1000 and another unfavorable transaction of 1000. So if you add up absolute terms, the turnover became 2000 rupees. And not the actual sale consideration that you have from sale of that particular security.
So add only the profit and loss.
Profit and loss in absolute terms.
And mention it as turnover.
Turnover is. Nowadays, the broker houses have become very smart and in line with the income tax provisions. So once you download the capital gain report, it will automatically give you what is the turnover, what is the profit that you have to report in your ITR. Before maybe 2 years, 3 years back, they were not reporting turnover in the reports. We had to manually sit and calculate what is the turnover for that year. But now almost all the brokers are little advanced and they already give what is the turnover that you have to report in the ITR.
Then both column will be same, not? While the turnover will also be same and profit and loss will be same.
No. Turnover will be addition of absolute terms. So say in my example, from one transaction I had 1000 profit. From second transaction I had 1000 loss. So my profit became 0, but my turnover became 2000. Because I added profit plus loss in absolute terms. So turnover and profit will definitely be different numbers.
So in this case, just because I have done some or one or two or intraday transaction, so the department is debarring to me for shifting from new regime and old regime. That is there, no? Because I have income from business.
Yes, that is
If I show under
that is the small exposure that you have to take.
other income, if I show?
No, you can't. That is not possible.
But what if my intention was to hold it for a long period, but I sold it on the same day because I was...
No, that is not possible. So
Intentionally.
you treat it as capital gain or business income for delivery transactions, there is a circular. But for intraday transaction, it is a straightforward speculative income.
And the speculation, what are the expenses on your generally in share transaction?
All the expenses that you can claim, STT, you can claim stamp duties, and you can claim turnover, transaction charges, all those you can claim. There is no bar.
So in case of NRS, so I mean something like 5 to 6 years back they went to outside India. Do I need to report outside India income also?
No. For NRIs, there is no requirement for incomes that they earn outside India. But for NRIs, the only reporting requirement is the incomes that they earn in India. So scope of income is clearly defined in section 5, wherein either income.
Okay, it is not forming part of income, so that's why I need not to disclose. You mean to say?
No, you are saying for intraday transactions.
No, anything.
Any income for NRI. If that income is accrued in India, they have to report that income and pay taxes on that. If it is not accrued or received in India, they need not report that.
No need to disclose.
No need to disclose also.
Even foreign assets also.
No. Schedule FA is applicable only for residents. Non-residents need not disclose their foreign assets. Coming to F&O transactions, this is similar to what we discussed as the internet transaction because the calculation of turnover is similar, the calculation of profit is kind of similar, only that this is done through a derivative transaction. So the derivative could be futures, derivative could be options. So there are certain issues which revolve around this F&O. What is the turnover? What is the profit? Whether should I maintain books of account or not? Whether can I take presumptive taxation for F&O transactions? So these are the things that we'll be dealing in this slide. So firstly, do I have to maintain books? You maintain it or not, broker will give you the books. He will give you the report, they will give you what is the profit. So there is nothing for you to maintain. So for you to maintain, if at all there are certain additional expenses that you want to claim against F&O. So for all those things you can maintain some books or vouchers or receipts or some of such sort. But otherwise, on a general note, books are already maintained for F&O transactions. You just need to click on download report. The report will give you all the books for the year. Now, as far as statutory compliance is concerned, this again falls under regular business and books maintenance of books required or not again falls under 44AA subsection 2. If your turnover for the year exceeds 25 lakhs or profit exceeds 2.5 lakhs for the year, you are mandatorily required as per the statute to maintain books of account. So can I offer presumptive tax under 44AD for F&O transactions is the question. Is there any restriction in law? Absolutely no. There is no restriction in the law to claim a 44AD presumptive income for F&O transaction. But the slight catch is that under presumptive taxation, let's say my F&O profit for this year is 50%. My turnover is 10 lakhs, my profit is 50%, where I have earned 5 lakh rupees of profit. So presumptive taxation under 44AD gives me an option to offer 6% of turnover or such higher profit which I have actually earned in the year. So I have actually earned 50%, so I can't offer 6%, I have to offer 50% as my profit under 44AD. So what happens next year? Next year I have a loss, or say for example I have a profit which is lesser than 6%. What will happen? We all know breach of 44AD offering lesser than 6% will trigger tax audit under 44AD. Unnecessarily, the client will have to go through the process of tax audit Unnecessarily, the client will have to go through the process of filing Form 3CD, Form 3CA, 3CB, and for us professionals also, we will not get any additional fees for doing tax audit for F&O clients, because in their mindset, their ITR fees itself will cover everything that we have to file for that particular year. So we will also not get any additional fees. So unnecessarily, the assessee will have to go through all these burden. So on a general sense, I would say it is not recommended to opt for presumptive taxation, because the market will always be very volatile. 1 year I may earn 100% profit, 1 year I may earn 50% profit, 1 year I may end up bearing losses. So in those cases, it might mandate for us to go for tax audit, which will be additional burden for both professionals as well as the assessee. So it is definitely not recommended for us to opt for presumptive taxation for F&O transactions. But as far as statutory is concerned, is there a restriction? Absolutely no. The law will not debar you from opting presumptive taxation. You can offer the actual profit rate and offer under 44AD. You need not provide all the P&L or the balance sheet items of the F&O transactions.
But we need to fit in the specified business as prescribed under 44AD.
Yes, that we have to choose. And this transaction it comes under other services, because there is no specific code for F&O transaction.
You mean to say other services means any business we can take up?
Yes. Any eligible business, because eligible business is defined as business that has less than 2 crore turnover. It should not have agency income. It should not have commission income. Unlike 44ADA, 44ADA is an inclusive this thing. There is an exhaustive list wherein only if I fall under these many professions, I can take 44ADA. But 44AD is like it is excluding the type of assessees who cannot claim. So there are certain 2-3 codes of nature where 44AD is debarred. But apart from that, any other code you choose, 44AD will be applicable. So it is the case.
So generally F&O, they are done by retired people and all. So 9 out of 10 they are earning losses.
Correct.
They don't file any return because in any case loss and so any problem with that?
They just cannot carry forward the loss over the future years. So in case, say for example, 7 years they made loss, but 8th year they made huge profits. But since they did not file returns, we all know return of losses has to be filed within 139 due date. Otherwise, it restricts carry forward of losses. And if there is no return filed, absolutely there is no provision for bringing that losses to the current year. So in such cases, it will be difficult for them to adjust those losses. That is the only problem. Otherwise, in other sense also, I would say filing the return is essential. So if they are having some losses, it is always essential for them to file returns. So that's to carry forward those losses and adjust in the future years whenever they make profit.
What they think, no, already I am incurring losses, filing return is also a loss.
Filing return is actually giving them a benefit of carrying it forward to the next year.
And also compliance.
Yes. Compliance, as a compliance part will also happen. That is why I mentioned in the earlier slide. It is the responsibility of the professional to educate them and say if you don't carry it forward to the next year, it will be difficult for you to adjust against the profit if at all you are making in the next year.
Sir, we are talking about F&O who is making losses. I know a person who makes so much of profits in shares, and when I asked him, I have given a gyan that you have to file a return. He gave me 1.5 hour gyan. On one day you will get a notice that is different.
The very unfortunate part is these F&O transactions are not appearing in AIS.
Yes.
So this is a very unfortunate part. I think they will come up with some solution, because sale of securities is appearing, but sale of this purchase and sale of this F&O is not appearing.
No, turnover can also appear, no? Because you said it is in any case the net of gross up of the net amount.
Yes, but as far as brokers reporting is concerned, there is no provision for them to report purchase and sale of derivative transactions. They will report only purchase and sale of share transactions. So because of that, the AIS of the assessee will not reflect what is the turnover or what is the transaction that you have made in F&O. That we have to voluntarily ask the client whether they have made any F&O transactions during the year. Coming to disclosure of turnover, do we have to disclose the turnover anywhere in the return? No, there is no requirement. Calculation of turnover is essential only to determine whether audit is applicable or not. So as far as reporting is concerned, we just have to, in case of profit, go to operating revenue, just put profit from F&O. If there is a loss, just go to direct expenses, put loss from F&O. That will take care of the computation part. And against that profit or loss, we can claim certain expenses that are directly linked to F&O transactions. Say for example, you have incurred STT, you have incurred stamp duty, or there are chances that those who are making a lot of profit, there are huge chances that they have subscribed to some sort of a research entity wherein they get some research reports and all those things. I will come to that on applicability of TDS provisions.
Even in intraday, there is three options: sale of services, sale of goods, and professional.
Correct.
Don't they have to report in sale of goods like intraday also?
Yes, yes.
They have to do it.
Comes under that sale of business. I mean sale of.
But
yes,
F&O you need not report.
No, you need not report. That's why I mentioned under speculative, there is a requirement to report turnover. But under F&O, there is no requirement to report turnover. We can directly report profit or loss.
See, in P&L, we have the profit or some portion of profit or loss, both are. We have to report net.
Yes, net. But if there are two segments, say assessee has profit from futures, loss from options. So that case we can report profit in revenue, loss from options in direct expenses.
So net is okay.
Otherwise, if there is only one segment, the net profit or loss we can report there. And claim of expenses, I already mentioned, we can claim any expenses that are directly linked to earning that revenue. Applicability of tax audit, it is same as any other business. So applicability of tax audit is already governed by section 44AB. So if the turnover breaches 10 crore rupees, because F&O transactions happen on the portal, there is no requirement for us to check whether there is a cash transaction or not. So if it is purely a F&O income, the turnover limit for applicable tax audit will automatically become 10 crore rupees.
So now, in that case, suppose 1 year it exceeds the limit, second year they reduce this below the limit, even for 75 lakhs also. So 1 year I have to do, next year I need to do, again third year I have to do like that.
Yes.
But then it means that I should continuously maintain my books of accounts.
Yes, maintenance of books will always be there, because if your turnover is say 50 lakhs, then you are automatically breaching the limit of 25 lakhs.
Okay.
So maintenance of books flows from the 25 lakhs turnover limit.
If I am claiming the particular AB or AD or whatever it is, so if I am going for a presumptive taxation system, then I need not maintain books, no?
Yes, in the year in which you opt for 4480, you need not maintain books.
Okay, but next year supposing my income is more than that, then that year I need to maintain.
You have to maintain.
How can I, unless you have opening balances, you can't.
That is a practical. In order to have opening balance, we have to prepare books for last year as well as this year. That is how we have to do.
So even in ADA case or AD case, we have to give a 4 figures. Got to maintain the, how can the surrender data, cash?
That is again practical, difficult. So the law assumes that even if you don't maintain books, you know at least these 4 transactions. You know at least how many people should pay you, how many vendors payment is pending, how much cash you have.
May not be accurate.
Correct. So you should have every business person will have some sort of idea as to how much cash they have, how much inventory they have. Even if they are not maintaining books, it is very definite that they have control over these 4 transactions. So look out for applicability of TDS provisions. This is very important. Say for example, your turnover is more than 1 crore rupees in the previous year, only from F&O, I am talking only from an F&O perspective. So up to 10 crore rupees, since your transactions are non-cash basis, you need not undergo tax audit. So before, what was the provision under TDS? If an individual or a HGF is subject to tax audit in the previous financial year, then the applicability of TDS will be triggered in the current year. Most of the TDS provisions, say for example 194C, 194J, 194H and so on and so forth. But now what is the amendment? What does the amendment say? I think it is from 2020. So if your turnover in the previous financial year exceeds 1 crore rupees, then you are liable for TDS provisions in the current year. So in my case, say my F&O turnover in the previous year is 5 crores, and since this is less than 10 crore rupees, I am not subject to tax audit. But since my turnover is more than 1 crore, for the current year I need to look out for TDS applicability. That is where this subscription to this research papers and all those things come into play. So there are a lot of people whom I also file returns. They subscribe to certain research reports wherein they do a lot of detailed research and analysis, and they give some sort of a summary or a summarized report or something where they tell you how to buy an option, how to buy a future, and the subscription rates are as high as 3 lakhs per annum, 4 lakhs per annum and all that. So on those subscriptions, definitely TDS provisions are applicable. and since your turnover exceeds 1 crore in the previous financial year, you should definitely look out for applicability of TDS on those transactions. We definitely we are prone to missing out on this because our mind is mechanically set as to whether tax limit is applicable in the previous year or not. But since the turnover limit is applicable now, we should not miss out on looking for TDS applicability.
Sir, out of this, the person who is having a presumptive taxation, 4480 normal business, trading poor, in that case also if the turnover is more than 1 crore, then in that case also TDS is applicable, no?
TDS is still applicable.
Still applicable.
TDS provisions are regardless of whether you are opting for presumptive or not.
Yes, more than 1 crore.
Yes. It is a different matter that whether disallowance is there or not, because the allowance under 30 to 38 is deemed to be provided.
Yes.
So disallowance under 40A, 1A may not be triggered for presumptive, but the penal consequences under the TDS provisions will definitely be triggered.
But how they will come to know it is not initiated the TDS when under 4480 we declared the specified rate of taxes, and there is no question of disallowance under on account of 40A, 1, 2. But how it will come? I am not going to initiate the TDS.
Correct, but if in case there is a scrutiny happening, the officer will definitely find out that there are transactions that are subject to TDS and we have not done it. So that time there are
It is only perhaps exchange of information that will be caught for.
Correct. So coming to disclosure of foreign incomes, we have already discussed that salary income might also include something called allotment of ESOPs. So what do we have to report as a foreign income? Because yes, sir.
See, in case of TDS, so I receive the payment from the client. He may deduct the TDS, but he pays me net. He doesn't remit the TDS. Okay, so because I have got a credit in my bank account, I have paid tax on that. Suppose next year he pays the TDS, and then that again comes in my 26 years as again amount and TDS both will come. So how should I? Because I paid in the last year, again I am forced to pay this.
Correct. That becomes a reconciliation issue. You have to first push the assessee to give credit to the actual year in which income you have already offered. So before filing our own income tax returns, we should also make a small reconciliation as to whether all the clients have given appropriate TDS credits or not.
Right.
And if at all the clients have not given TDS credits, it is our duty to definitely push for it.
But he doesn't have money, so he didn't pay TDS. So he is paying the next year.
Next year, sir, practically if you see, next year we should also see how much turnover we are reporting in total. So if that total turnover which we are reporting is less than the total receipts as per Form 26 says, nothing stops me from taking credit of that credit and also taking credit of the TDS credit that I get in the next year.
Okay, so
it becomes a little difficult when all the receipts are subject to TDS, and because of this one particular entry, my total gross receipts as per 26 years is exceeding my turnover that I have reported. Even in those cases, you have the option to get the rectification done from the assessing officer saying this is income that I have already offered in the last year. So you have to give all the reconciliations, you have to give details of the bills that you have raised, and all those reconciliations will have to be provided. That is possible. Disclosure of foreign incomes, there are chances that the employees would have got allotment of ESPPs and RSUs. So what do we have to report? We have to take something called holding statement as on December 31st. The only problem with Schedule FA is that the reporting happens based on calendar year and not financial year. But the incomes arising out of such foreign assets will have to be disclosed in the computation as per the financial year basis. So this becomes a slightly headache for us as professionals in order to prepare some sort of reconciliation, because if I stand today, I am filing returns for financial year 23-24, but the holding statement or the income statement, for example in the US we get something called Form 1042S, wherein it gives us the details of incomes that are offered against this particular person in the calendar year 2023. So there are chances that this income is earned in the first quarter, which is Jan to March 2023, which I have already offered in my previous year's return. And there are chances that I have in the current year's return, I have reported certain incomes that I have earned in Jan to March 2024, but those are not forming part of the tax credit statements that the assessee will give from the foreign country. So what we have to do is, we have to make some sort of a statement wherein what is the income earned from January to March 2023 and check that whether the appropriate reporting has happened in the last year. we should also maintain what is the income that is earned from April to December of 2023 and club Jan plus March incomes and see whether tax credit is given for that in the form that the assessee produces. The third table will be what will be the incomes that are earned from Jan to March 2024, for which the tax forms for that period is yet to be obtained, which has to be obtained in the next year when the assessee gets 1042S of 2024. So this sort of reconciliation is slightly painful exercise, but it is very essential because Schedule FA, say for example I have stocks of Microsoft, say 1000 stocks, for which I have paid around 20 lakh rupees. As on 2023 December, I disclose in my Schedule FA, I have 1000 stocks of Microsoft, which costed me 20 lakh rupees. I also have to report what is the peak value, what is the value as on December 31st. But say, for example, if I get a dividend income of that in January 2023, which I have reported in my previous year's return, for which the assessee produces tax statement now, because in US tax statement is generated as per calendar year, which is Jan to December 2023. What should I do in such case? In such cases, we have to report that income in Schedule FA, because Schedule FA is calendar year basis. We have to report what is the income that is offered to tax in India for that calendar year, which is 2023. But correspondingly, in my computation of tax, there is no income reported. Why? Because I have not earned that income during the financial year 23-24. What to do in such cases? CPC is not processing those returns with adjustment as of now. But just in case there is a scrutiny that comes up in the future, this particular reconciliation table that we have prepared will come into help, and we can produce that this, even though this entry is not reported in the current year's income, we have already reported in the past year's income, because computation of tax in India happens on a financial year basis and Schedule FA happens on a calendar year basis. This reconciliation is very important for us to keep and prepare for our records also, for assessee's record also. We should definitely not miss out on preparing this reconciliation table for any assessees who are claiming foreign incomes and having foreign assets. So we should not miss out on reporting incomes arising. We should also look out for tax credit if any that is given, and we can file appropriate form 67 for claiming the tax rate in India. Reporting of sale transaction comes under the normal capital gain. So it doesn't come under listed securities, because even though it is listed securities as per Income Tax Act means the shares that are listed in the Indian Stock Exchange. So since it is listed in a country outside India, this comes under the normal category of unlisted shares. So but the sale transaction will still come under the head capital gains. We should not miss out on claiming foreign tax credit, and Schedule FA is calendar year basis and not financial year basis. And I have made a note of certain important forms that needs to be filed along with the ITR. There are a lot of forms that are notified, but I have identified certain important forms that we should not miss out. Those forms include Form 10 IEA, which is filed to opt old tax regime in case the assessee has income from PGBP. So what happens if in case the assessee has income from PGBP, for opting out of new tax regime and opting in for old tax regime, a separate form needs to be filed, which is Form 10 IEA. For assessees other than the ones who are having PGBP income, the same can be exercised inside the return itself. We need not file a separate form for that. What is Form 10BE? This is a new form that is introduced from last year, which is 2023, wherein the trusts that are approved under ATG will have an obligation to file something called Form 10BD to report all the donations that they have received during the financial year. And upon successful filing of that Form 10BD, we get to download something called Form 10BE, which will be given to individual donors. So each and every donor a separate Form 10BE will be downloaded for each and every donor, and that ARN of that 10BE needs to be reported in Schedule 80G in order to claim deduction under 80G. Although I don't think that has become a validation error if you don't enter ARN, because this is still in an implementation stage. Last year there was an official notification out saying the ARN of 10B need not be reported for this year. You can go ahead and claim 80G. But this year, although there is no formal communication from the department, I suppose there is no inappropriate processing happening at CPC level. for not reporting of ARN, but definitely this will be a point of validation error in the coming years. If you don't report ARN of 10 BE, you will not be eligible for claiming deduction under ITG. What is 10 E? It is for claiming relief under 89. We discussed something called arrears of salary that is received. So in order to claim relief under section 89, there is a separate form called form 10E which needs to be filed along with the ITR. And the acknowledgement number and date of filing and all those things will have to be reported in the ITR. Form 10IA we already discussed for claiming deduction under 80DD and 80U. A form 10IA needs to be filed. The acknowledgement number and the date of filing form 10IA needs to be disclosed in the ITR. Form 67 is for those who are claiming foreign tax credit. If you are a resident Indian claiming foreign tax credit against incomes that are earned outside India, you will have to file something called Form 67. Please make sure there are two schedules. You can note down this Schedule FSI and Schedule TR in the income tax return. So whatever information that is disclosed in Form 67 needs to exactly match with the information that is given in these two schedules. So please make sure before filing the ITR that these schedules are in line with Form 67 that you file, so that CPC can appropriately process and make cross calculations and give the credit under 90 or 91, section 90 or 91. Form 3CA, this way I don't have to tell. It is required when there is an audit under section 44AB of the Act. So there are a lot of other forms, but I have just listed out on these forms which we should not miss out, because this will have direct impact. If you don't file Form 10E, relief under 89 will be denied. If you don't file Form 10IA, you cannot claim deduction under 80DD. So since these forms have a direct impact on the computation, I have just noted it down so that we don't forget.
What is the timeline for filing this 10 IEPA in case of?
It is before the due date of filing the return. Because the exercise of option under 115 BSA subsection 6 has to happen before within the due date under 139(1). So since that is coterminous with this particular timeline, we have to file it within the due date under 139(1).
Simultaneously along with the return only we will file this.
No, we have to first file 10 IEA and we have to report the acknowledgement number and date of filing of that form in the ITR. Only then you can exercise option under 115 BSA subsection 6.
Can you file 10 IEA before the due date and can you file the return later?
No, that is not possible. Because in substance, we are exercising option under 115 BSC. So that has to happen within 139 due date. Just because you have filed Form 10 IEA within due date, we cannot file the return later and claim old regime. So both have to be filed within the due date.
So let's assume that we have filed in the new regime. Can we revise it for a old regime?
But that is also technically not possible. Even though we can say there's a Dhampur sugar mill case where it says the revised return sits in place with the old original return and all those things. Those judicial precedents will not work for forms. So Form 10 IEA will have to be filed within 139 due date. So that
So
can
due date suppose let's assume that now I filed today I filed a new regime. I want to file tomorrow on the old regime. Is it possible? Revise it later.
Yes, I think that is possible. Inadvertently you file Form 10 IEA, you can still go for new regime under 80. But in order to exercise old regime, filing of this form is mandatory.
No, but if where under 139 if filed belated return, then what is the status of 10 IEA?
It will lapse. Yes. So the ITR also has to be filed within the due date.
ECG, even for one donation claim also we have to file claim.
Yes.
Even 10,000 rupees they have donated to some charitable trust. For claiming that also we have to.
Yes. The amendment is clear in 80G, wherein if an assessee being a donor to a trust approved under section 80G, the return under 10BD will have to be filed by the trust, and the trust will have to download 10BE in order to claim, in order that the donor can claim deduction. No, that amount is not there. Yes.
It only asks for the PAN number in 80G. It does not ask anything. Just asks for the PAN number.
There is an option now. You can enter ARN. There is a new cell that is inserted last year, 2023. So you have to enter ARN. As of now, CPC is not denying 80G credit if you don't enter ARN. But definitely in the years to come, it will start denying credit. Some other points quickly we'll discuss in 5-10 minutes. quarter in which income is accrued is very much needed in order to calculate appropriate interest under 234C. Credit of taxes, we need to check both in 26As as well as AIS. Why? Because from last year or last 2 years, credit of self-assessment tax and advance tax is not appearing in Form 26As. So this has to be prefilled from AIS only. So for claiming credit of taxes, you have to check both 26As as well as AIS. Credit of taxes is very, very crucial. Why? Because let's say you have not claimed any TDS credit at all. After the return is processed and the due date for filing the revised return is also over, it becomes very difficult for us to get the rectification done. Say for example, if the assessee comes to me and says, "Sir, I forgot claiming TDS credit, but the due date for filing revised return is also over, related return is also over. The only option that I have is filing ITR, which will not allow me to claim a refund." So what will happen in such cases? The assessing officer will say that you yourself have not claimed TDS credit in the return. Why will I give you credit for that? So the only option left for that assessee would be to file condonation under section 192B of the Act. So that will become a very huge process. So which is why we should not miss out on any TDS credit, even though there are certain confusions with respect to a particular vendor not filing the return as on date. You still go ahead, take the information, take the TAN number, take the TDS amount and claim that credit in the return. Even if 143(1) return is processed with the demand, the vendor might subsequently file the return for the previous year. So once the vendor files the return, you can apply for a reprocess of this return and the return will appropriately process with the credit of taxes.
But even after intimation under 143, can you go ahead with claiming the same amount?
No, but this has to be claimed in the return is what I am saying.
That's what.
Yeah, if it is claimed in the return.
But before that, other party is filing his TDS return 143(1).
143(1) will deny the credit because corresponding credit is not there in 26As. But once the party files its 26Q, after that we can apply for reprocess and then the CPC will appropriately process. Even if CPC doesn't process, we still have the option to get the manual rectification. But if you have not claimed any TDS credit at all, the officer will directly deny giving credit because you have not claimed in the return of income.
No, there is also one option, the AIS, you can upload the correct TDS so that it matches with what you are claiming. 26AS you cannot do anything, but AIS you can say it is not denied, that is information is denied and then file so that
but sir, CPC is still processing based on 26As. The return will not process based on AIS. CPC has traces information which appears in 26As. So CPC is not yet designed to process returns based on information in DIS or AIS.
AIS is carrying only advance tax and self-assessment taxes addition to the 26AS.
Correct.
So I think 26AS is the prime document for the CPC.
Correct.
They are going according to
Because CPC in itself is also designed in line with places. So the same system is being adopted. The ITBA is also designed in a similar fashion. So it is easy for CPC to process based on 26As.
no, correct, but TIS, tax information summary, that is also a part of
correct. So that is helpful in giving red flags to the officer. So for initiating verification under 135A, for issuing notice under 133(6). So for all those e-campaign, e-verification reports under 135A, AIS information will be very helpful for the officer. But as far as CPC processing under 143(1) is concerned, it purely looks at the tax credit that is appearing in Form 26As. Payment of taxes, is it necessary? Can I file showing the net tax payable? Yes, it is possible. I can file saying the tax is still pending to be paid, where which the return will be processed with the demand and subsequently I can make the payment. So before it was not allowed. Long back it was allowed. After that, after that there was an amendment in 139(9) wherein the return was being made defective. And then again they removed the amendment and now they are saying you can still file the return by showing as net tax payable. Post which a demand will be raised and then you can make the payment of demand. One more question, when Aadhaar is not linked with PAN, the PAN will automatically become inoperative. Can I file the ITR? So my question is, will inoperative PAN restrict me from filing an ITR? Can I still file ITR?
No, you cannot file like
You cannot file? You can file? So I'm getting diverse answers.
No, you can file, you have to send a physical acknowledgement to the CPC.
Okay, but what if I verify using EVC? EVC doesn't require linking of Aadhaar and PAN. So I will file ITR and verify using EVC. Is it possible or not?
EVC requires Aadhaar. to be
No,
linked.
no, EDC can be generated to bank account also.
Bank account
Yeah,
it
yeah.
has to be.
Can I still file the ITR is my question?
Yes.
Yes. Because there is a difference between PAN being inactive and PAN being inoperative. So if it is an inactive PAN, it is stopped for using for any purposes, for sending notices, for filing ITRs, so on and so forth. But if it is inoperative, it has some sort of restricted usage. Say for example, I can still file the return, but I cannot claim a refund. So if there is a refund in the return, I have to still link my Aadhaar and PAN. I have to still make the PAN operative, go to the portal, request for a refund reissue, and then the refund will be issued to my bank account. So if you have an inoperative PAN, you can still go ahead and file the ITR, but you will not be getting credit for a refund that you have claimed in the ITR. Certain general tips, yes sir?
In case of inoperative PAN, recently one session for so one person is buying a property from other person. The seller doesn't have seller PAN is inoperative. They got a demand of 14 lakhs or 15 lakhs.
Because automatically 206 AA gets triggered, wherein all the higher TDS provisions become applicable. The buyer Papa will not know whether PAN is operative, and unfortunately in the income tax portal we do not have an option to check whether the PAN is operative or not. We have to check only using traces portal. So as a common man, unfortunately it becomes very difficult to understand whether the other party's PAN is operative or not. That is a practical difficulty which everybody is facing, especially with respect to these property transactions where huge demands are being raised. So quite unfortunate, but nevertheless we have to follow the law. Choosing the right ITR is very important. Before filing the ITR, we have to make sure appropriate ITR is chosen. Claiming complete tax credit we have discussed. Set off of brought forward losses. Why is looking into previous year's ITR is important is because there are high chances that in the current year's return, the pre-filling of brought forward losses may not happen. So the assessee might have huge brought forward losses from this year, and there are chances that those losses are not getting pre-filled in the current year's return. So we should always make a point to see previous year's return, open schedule CFO, and see whether there is any losses that are being carried forward to the current year. So that one small exercise is very essential. Manual calculation, if possible, we can get it done from the staff, and also see whether the approximate manual taxes that we are calculating is in line or approximately somewhere nearby the taxes that are being calculated in the system or the portal, so as to ensure whether all the information is correctly filled and the proper rates are being applied on all the incomes that are reported. Documentation, I cannot stress more, because documentation is something which we are following for all other works as chartered accountants, even if it is audit or taxation or anything of that sort. Documentation is very important, because in case of scrutiny or in case of further verification of documents, it becomes very crucial, because client will usually say, I have given it to my CA. I do not have that document now, because they wash their hands and clear out their responsibility once they give all the documents to us. So it becomes our responsibility, our duty to download all the documents. Please do not work by opening the documents on your email, because both Gmail and Outlook has an option to open the document there itself. So you can directly open those documents, you can work on those documents, file the return. But 2 years later, when the scrutiny comes up, you will be in a very big trouble, where you will not be able to find those emails, or the emails would have become redundant because of some storage issue or something like that. So it is always important for us to download all the documents, keep in appropriate folders before verification of ITR and filing the ITR. Verification of ITR is very important. Why? Because when you verify it within 30 days of filing, the date of filing will be the actual date of filing. But once you verify the return, post 30 days of filing the return, the date of verification will be deemed to be the date of filing the return. So if I file a return on July 30th or 31st say, if I verify the ITR within August 30th, my date of filing the ITR will become July 31st. But if I verify the ITR on August 31st, August 31st will become deemed date of filing. So all those consequences of not carrying forward the losses and if you are opting for old tax regime, those consequences will definitely follow if you don't verify the ITR within time. So it is very, very crucial. Before the timeline was 120 days. Unfortunately, from last year it has been reduced to 30 days. We have to file it within, we have to verify the return within 30 days. Certain general tips, disclosure of personal assets and liabilities if income is more than 50 lakhs. Why is this important? Because if you don't mention anything, the return will automatically say there is no asset, there is no liability. So it is important for us to check with the client if their income is below or if their income is above 50 lakhs. We also should ask them for giving the details of their personal assets and liabilities. Very simple schedule, you just have to mention if there is an immobile property, you have to mention address and cost. And you have to mention the cost of acquisition, not the current market value. You have to mention what is the cost of purchase of immobile property, cost of purchase of jewelry, cost of purchase of any vehicle if it is there. And we should also ensure we report bank balance as of 31st March. And if there is any liability, say a bank loan or some loan against that particular asset, we also have to report what is the principal outstanding as on 31st of March.
How is it being used, this particular information by CPC? Is there any use, anywhere it is being used?
CPC will not use this piece of information, but it could be used, say for example, you have reported an immobile property of just one immobile property you have reported which costed you 20 lakh rupees. But during the year you have purchased another property by paying 1 crore rupees. So that becomes a straight red flag for the officer to say you have purchased the property of 1 crore, but in your schedule area you have disclosed only properties worth 20 lakhs. So they will start asking where did you get the source for purchasing this particular asset. So that could become a red flag for selecting student.
As well as non-disclosure may lead to undisclosed income.
Yes, definitely. Yes,
That
definitely.
giving information works against you.
This one 133 or something happens, no? That time whatever the list of assets,
Right.
whatever I disclose, no, that time it will affect it.
Yes, yes. They will say you have not appropriately disclosed assets, or that will directly have an impact on to such an extent that they will say you have not filed a correct return of income. So that might have such serious consequences.
No, in addition, they will tell forget your asset tax. You will take it.
Right. Don't forget to claim foreign tax credit because it is very crucial in case you have paid a lot of taxes outside India. Details of partnership. If you are a partner in any partnership firm, yes sir.
In case of disclosure of foreign assets, securities, foreign shares, should we fill under this schedule?
No. This comes, no, if you have both, I would say in my view, if you disclose it under foreign assets, it should be sufficient.
So that is very important, disclosure of foreign assets.
Correct.
Much
That is where the black money complications will all pitch in.
In unlisted shares also, foreign securities.
For that unlisted, yes, we can
So
do
we have
that.
to fill
Yes,
both
we
the-
can do that. We can do that.
Both the schedule.
Correct.
Extra schedule also.
Yes, that is right. In case of having an unlisted share in a company where you mentioned
That
what
is
is
foreign.
yes, because foreign companies shares
Unlisted
become
in
unlisted
India.
shares in India. So you will have to disclose in the unlisted shares.
As well as here.
Yes. So if you are a shareholder in any company, you have to disclose which company you share. Obviously, this is for unlisted shares, not for listed. You can't mention all the listed shares you are holding. So this is only for unlisted shares. And if you are a director in a company, you have to disclose what is your DIN and what is the name of the company. So that you have to disclose. And are you a director or are you an additional director? All those things you have to disclose. Country of residence. This is in case of non-resident, wherein you are a non-resident filing a return in India. You should mandatorily disclose what is your actual country of residence where you are residing, and you should also mention TIN number, which is taxpayer identification number. In case you don't have TIN, you can enter the passport number. So that option is definitely there. And you should also mention the number of days of stay in India in case you are a person of Indian origin. So you are a person of Indian origin working somewhere outside India and you are a non-resident. You should also mention how many days you were there in India during the last financial year, plus how many days you were there in India 4 years before last financial year. So that is very crucial in order to determine what is the residential status of the assessee. Relief under section 89 we have discussed. Reconciliation of the numbers with the other filings of the assessee. Here assessee has GST registration. So before filing the ITR, we should also mention what is the turnover disclosed in the GSTR. So that is also an additional, kind of a check in order to establish whether we are reporting correct turnover or not in the income tax return. And even those holders of food license also have something called annual return under FSSAI, which is filed within 31st of May. So you can definitely ask for the returns data and reconcile the numbers that are reported there. And if there is any major deviation, you can sit with the client and discuss what are the reasons for variation. which is the actual numbers and all those things we can discuss. And MCA, of course, for corporates we have numbers, everything reported in MCA portal. We can have a look at what are the numbers that are reported in the annual report and MGT and all those things before we finalize the return. This is just for this will act like an additional check. This is not something which is mandatory to be done, but this will give us some sort of comfort as to whether we are reporting the numbers in the ITR appropriately or not. F&F reports, we have discussed that in case of salary switchover, it is important for us to take F&F reports to explore exemption options if there are any. We had some sort of checklist, but that's a very basic checklist since we are not having much time. I think we'll just skip that. Choose the right ITR, a small exercise, because choosing the right ITR is very important. I just thought whether at the end of the session we can have like a small exercise as to see which ITR will have to be filled in these particular cases. So a resident individual having salary income of 67 lakhs, ITR 2, why? Because ITR 1 will not allow us to file return when the total income is more than 50 lakhs. Resident individual having salary income of 12 lakhs, LTCG of 2 lakhs.
ITR 2.
Again ITR 2 because ITR 1 definitely doesn't have capital gain schedule. A non-resident just having a mere 5 lakh FD interest.
ITR 1.
ITR 1 is not applicable for non-residents. So non-resident basic return becomes ITR 2. So ITR 1 will not allow you to file return for non-residents. Both ITR 1 and 4 cannot be filed for non-residents. It should be either ITR 2 or ITR 3 depending on whether they have business income in India or not. Again, a resident individual having income under 44AD and also a capital gain of 5 lakhs.
ITR 4.
ITR 4 can be filed for presumptive taxes, but capital gains cannot be reported in ITR 4. So because of which I have to file ITR 3. ITR 4 and ITR 1 are very identical. If any condition is there that is restricting me from filing ITR 1, the same condition will be applicable for ITR 4 also. So since capital gain cannot be reported in ITR 1, I cannot report capital gain in ITR 4 as well. So ITR 3 needs to be filed for this particular assessment. A resident individual having salary of 15 lakhs, but a brought forward capital loss of 13,000 that needs to be carried forward. I don't have capital gain or loss in the current year. In the current year, I have only salary income of 15 lakhs, but I have a brought forward loss of 13,000 that I don't have any option to set it off against this year because I don't have capital gain income in this year. But I want that capital loss to be carried forward to the next year.
ITR 2.
ITR 2 is the right ITR because CFL schedule is not there in ITR 1. So we have to enter ITR 2 for this assessment. Resident individual having 10 lakhs of salary and also shares of Microsoft that is listed in US. ITR 2 because ITR 1 cannot be filed for an assessee who is having foreign assets. So schedule FA opens up only in ITR 2, ITR 1 cannot be filed for that. So with this, I think we are at the end of the session. If you have any questions, we can take up.
Gain on sale of agricultural land. Is there any place to report in ITR?
If you say if it is a gain on sale of a rural agriculture, if it is an urban agricultural land, it automatically comes under the capital gain. So in case of a rural agricultural land, in my view, technically you need not report because capital gain under 45 comes upon transfer of a capital asset. Capital asset is under 2 clause 14, rural agricultural land is out of the scope of capital asset. So technically speaking, it need not be reported. But however, on a practical front, it is always important for us to report it in under exempt income, even though it is technically not an exempt income. Because let's say you have sold a rural agricultural land of 1 crore and made an investment towards purchase of securities using that proceeds of the sale of such rural agricultural land. So it becomes little doubtful when the assessee doesn't have any income in the ITR, but there is a investment to the extent of 1 crore rupees. So in that case, on a practical front, it is advisable to report.
But this is not an exempted.
It is not an exempt income. Yes, it is not an exempt income because it is not an income itself.
Or if filing a wrong return by filling exempted.
No, I don't think that, that over-reporting will not end up in So,
but sometimes if you fill 1 crore or 2 crore as exempted, you may cause for selection.
Yes, there are
a possibility, huge amount.
Possibility could be even when you don't report because anyways you have a investment of 1 crore where you don't have so much income. So possibility is there both the ways. Why not just report it as an exempt income?
In the schedule FA, fixed foreign assets, when you report something, that is for assets and income also on that asset, right?
Correct.
So assets and liability schedule, AL schedule, it does not say domestic AL. This again has to be reported in AL schedule also. Suppose you have shares of Microsoft, that has to be reported again in AL schedule if your income is more than 50, isn't so?
In my view, it is not required because I am already reporting that income, that particular asset in my schedule FA. So in my view, that again need not be reported because there are chances that the department might say for example, you have a foreign assets worth 1 crore rupees. In your case, Microsoft shares, and you also have a Indian investment of 50 lakhs. But overall, your income is around 1.5 crores in the last so many years, out of which you have purchased these two assets. So what happens if I disclose this 1 crore again in Schedule A? There are chances that the total assets in my name could be treated as 1.5 plus 1, which is 2.5 crores, for which I will not be able to establish sources. So it becomes like a duplication. So in my view, I think if you are disclosing a particular asset in Schedule FA, that need not be again reported in Schedule A. So
second case is also that FA is 3112 and AL is 31.3.
Correct.
So both will be different.
It will be different, yes. Schedule FA is categorically as on December 31st, which is why I told we need to prepare the table Jan to March 23, April to December 23, Jan to March 2024. It becomes like a easy sort of a thing when it comes to reconciliation.
See, in case of a joint property held jointly by husband and wife, suppose the tenant, because the rent now, the last year rent was less than 50,000, now the rent is more than that. So he made TDS and it made the PAN number only of one person there. So, but how does this, suppose next year onwards they have to show in one person's name or they have taken?
No, so technically speaking, this has to be split. So we have to report only your share of rental income.
So he paid off like that.
Yes, that is a practical difficulty that we face.
No, but what happened now is that one member's 26 years it is showing as a
Correct. So in case of an adjustment being made at CPC level, we will definitely have to explain saying this is a joint property held, and we'll also have to say the other part of the income is being offered in that other party's name. So this is a practical difficulty.
Somewhere I heard in ITR while filing TDS of others or something, we can transfer the TDS.
There's a separate process under 37BA which needs to be followed. If you're following that process, then you have to disclose that. But otherwise, generally we can show only our part of revenue as income from house property. In case there is a question or in case there is an adjustment, we'll have to produce documents saying this is
the party also has
the party has inadvertently given credit to the entire yes.
This is an instant case. Recently, this is what I observed. One of the employee has claimed the HRA with his employer worth of 5.5 lakh.
Okay.
That particular employee has left the premises using only for 1 month, whereas he has claimed for whole 12 months. Now it is anyway it is outside of the purview. It's one issue. This is what we observed. Categorically, we can say that he got only 75,000 rent in April. Thereafter, the property he left it, but he has claimed it. What is the way that SSC can take up this issue?
No, we cannot claim for the balance funds. If the SSC has
No, but it is reflecting in AS as he is claimed with the employer, whereas he got only 1 month rent.
Okay.
I am the landlord. I got only 1 month rent of 75,000 rupees.
Okay. You are talking from the owner's perspective. Okay.
Now that fellow has claimed with his employer for whole year.
We'll have to report only with respect to that 1 month, sir.
That's
because
true.
for the other months, anyways, some other tenant would have given you.
Probably she will get a notice from the CPC saying that.
No. As of now, CPC is not processing based on that other information that is put up in AS.
You mean to say they are not considering AS?
No, they are not technically considering AS. So this comes only as other information in AIS saying that this particular employer of this organization has reported your PAN and has reported a rental income of so and so amount, but that amount is not being taken up for processing by CPC. You can report the actual rental income that you have received, and if you obviously once the property becomes vacant, the other tenant would have come in and the rental income that you have received during the entire financial year will have to be offered under
So
income.
that the property itself is sold after 1 month.
Then you can report only 75,000 and you can leave the rest.
But is there any future if they are considered the CA's information where we are disclosed only 75,000 previous the employee has claimed almost 5
That time
lakhs.
I believe the department will give us an option again in that column also to give feedback saying 75,000 is what I have received, but the balance is inadvertently claimed in this by this employer. So we will supposedly we will give an option to give feedback.
Now also we can do that.
That giving feedback, I think it is not available in other information. It is available only in SFT information. So only in the SFT information, I have the option to give feedback whether this information is right or not. But this HRA thing comes under other information under AIS. As of now, in other information, we don't have that option. It might come up when CPC takes up processing based on that other information also. Yes.
Exchange of old gold for a new gold. Will it attract capital gains?
Exchange for old gold.
So 50 lakhs they will exchange for a gold.
I'm not sure, sir. I have to take back. Technically, the value of that exchange will become your consideration, but I'm not
Will it
really sure.
amount to sale or no? Transfer?
Yes, it is definitely a transfer because under the definition of transfer, exchange is also a transfer. So exchange includes, transfer includes exchange. So technically, it is a capital gain. But as far as computation mechanism is concerned, I'm not sure what should be the cost of acquisition or what should be the transfer consideration. It is a transfer for sure.
Because I read somewhere, see, it's exchanging old gold for a new gold. Maybe pattern or something.
And it becomes difficult because it is not reported also anywhere. We can wind up the session for that. Thank you so much. Thank you Bangalore branch for giving this wonderful opportunity. I will be ever grateful for this. Also thanks to Special thanks in fact to Deepak sir and Rani ma'am for recommending my name for this particular session. So thank you ma'am, thank you sir for this wonderful opportunity. Thank you audience.
Thank you, Karthik. On behalf of Bangalore branch, we thank you for your taking out your time and then coming here and sharing your knowledge and also clarifying all the doubts. It was a good interactive session and thank you. I request Chairman to hand over a memento to Karthik. Thank you, members, and see you next week with a different subject. Good night.